From July 1st, your employer can no longer sit on your super for months before paying it to your fund. It has to reach your account within days of payday. For a 25-year-old, that one change is worth around $6,000 at retirement, but there's a tax trap hiding in the transition. The ATO estimates the super guarantee gap at $6.25 billion for 2023. Not million, billion, in a single year. 3.3 million workers missed out on super, losing an average $1,730 each per year. And in 2024-25 alone, the ATO distributed $1.1 billion in unpaid super to roughly 960,000 employees. I've gone through the ATO data, Treasury modeling, and the legislation itself. Every figure is sourced. Links are in the description. If this channel helps you stay across your money, subscribe. There are more July changes that will need their own breakdown. Under the current system, employers pay super quarterly. They get 28 days after the end of each quarter to send contributions to the fund. So if your payday falls on the 1st of July, your employer doesn't technically need to move that super until the 28th of October. That's nearly 4 months where your money is sitting in their account instead of compounding in yours. I assumed it was a few weeks when I first looked into this. The fact that 4 months was legally fine is genuinely hard to defend. From the 1st of July 2026, that system is gone. The Payday Superannuation legislation received royal assent on the 6th of November 2025. This is law, not a proposal. Employers must pay super guarantee on payday at the same time as their salary and wages. Contributions must be received by the super fund within 7 business days, and super funds now have just 3 business days to allocate those contributions to your account, down from the current 20. That is a dramatic compression. Take Priya, 25, working as a marketing coordinator in Brisbane on $70,000 a year. At 12%, her employer contributes $8,400 in super annually. Under the old system that arrived in 4 quarterly chunks of $2,100, each one potentially delayed by months. Under Payday Super with fortnightly pay, those same contributions arrive in 26 installments of roughly $323. Same money, completely different timing. Each one hits her fund weeks or months earlier and starts earning returns immediately. Treasury estimates that earlier compounding adds up to an extra $6,000 in today's dollars for a 25-year-old median income earner over a working life. That's not extra money from the employer, it's the same 12%, arriving sooner and compounding longer. The Super Members Council puts the figure slightly higher, at around $7,700 on average across the workforce. The compounding benefit is real, but the bigger structural change is detection, and this is the part that stopped me cold. Under the quarterly system, unpaid super could go unnoticed for months. The workers hit hardest were those least likely to catch it. The Super Members Council reports that women already retire with a quarter less super than men. In 2022-23, 1 in 4 women, 1.5 million, had unpaid super owed to them, totaling $1.9 billion. Among workers earning under $25,000 a year, 1 in 2 had unpaid super entitlements over the last decade. Working women across Australia missed out on a total of $15.5 billion in super. $15.5 billion. That's not a gap, that's a systemic failure. Payday Super compresses that detection window from months to days. The ATO has said the reform will allow the ATO to detect unpaid super earlier and take action to help a business get back on track. The volume of contribution transactions is expected to jump from around 150 million per year to over 500 million, far more data points to spot gaps in real time. From July 1st, every employee can run a simple check. Open your Super Funds app, Australian Super, Australian Retirement Trust, Host Plus, and others all have one. Turn on contribution notifications. After each payday, confirm that a deposit matching 12% of your gross pay appears within roughly 10 days. For new employees, employers have an extended window of 20 business days for the first contribution, so the check starts from your second pay cycle. If contributions aren't appearing, Raise it with your employer first, then report it to the ATO or the Fair Work Ombudsman, which is now a formal reporting avenue for super non-compliance. If a like and subscribe helps more Australians hear about this before July, that button is right there. Now, the tax trap that salary sacrifices need to deal with before the 30th of June. The transition from quarterly to payday creates a one-off timing problem. Stay with me on this one, because the maths matters. Under the current rules, employers can legally pay the April to June 2026 quarter super anytime up to the 28th of July 2026. That's still permitted under the old system. But because that payment lands in July, it counts toward the 2026-27 financial year concessional cap, not 2025-26. Combined with regular payday super contributions from July onward, some workers could receive 15 months worth of employer super in a single financial year, for a timing quirk that they had no control over. Take Sarah, earning $100,000 a year. She salary sacrifices $18,000 into super. Her employer contributes $12,000 in SG, 12%. In a normal year, her total concessional contributions are $30,000, right at the current cap. In the transition year, if her employer pays the June quarter SG of $3,000 in July 2026, she receives 15 months of SG $15,000, plus her $18,000 in salary sacrifice. That totals $33,000. The 2026-27 concessional cap is expected to be $32,500. She's $500 over. That excess gets added to her taxable income and taxed at her marginal rate instead of the 15% super rate. For Sarah, the extra cost is around $100. For someone on $200,000 with aggressive salary sacrifice, the overshoot runs into thousands, taxed at 47 cents instead of 15. The government has confirmed its intention to introduce technical amendments to prevent this. Those amendments have not been legislated yet, so right now you're exposed. So if your employer ignores all of this, what actually happens to them now? The penalty regime has been rebuilt. The old penalty, $20 per employee per quarter, $20. That's not even a parking fine. That's gone, replaced by an administrative uplift of up to 60% of the shortfall plus daily compounding interest. Late payment penalties of 25 or 50% apply if the amount remains unpaid 28 days after ATO assessment. The old late payment offset, where making overdue contributions before the ATO intervened to reduce the charge, has been abolished. The ATO has indicated a lighter touch in the first year for employers making genuine efforts to comply, but from the 1st of July 2027, full enforcement begins. If you run a small business, the ATO's free Small Business Superannuation Clearinghouse closes permanently on the 1st of July 2026. Find an alternative provider and download your records before the 30th of June. 3 things to do before July. First, download your Superfunds app and turn on contribution notifications so you can verify payments from the first pay cycle. Second, if you salary sacrifice, review your arrangements with your employer or tax advisor now. Check whether the transition year puts you at risk of breaching the concessional cap. Third, log in to ATO online services through MyGov and confirm nothing is already outstanding. In 2022-23, 1 in 4 women in this country had super owed to them that never arrived. 1.5 million people, Payday Super won't undo that damage. That money is already lost. But it shrinks the window an employer can go silent on your retirement savings from 4 months down to days, and gives 14.9 million workers the ability to see it happening in real time. That matters. If this was useful, leave a like and subscribe for more breakdowns of the changes hitting in July. Check out one of these videos next. This is general information only, not personal financial advice. Please consider speaking with a licensed financial advisor before making any decisions.